Hello and welcome back to yet another exciting week on the stock market. In this week's episode, we will look into the financial news, in particularly what is yield curve control. Then I will give an update to my portfolio, and finally I will look into some questions which I have received from the audience. So without further ado, let's dive into the financial news for this week's episode. So over the last couple of weeks, I have been talking about what the Fed are doing and which tools they are using. And now it seems like all the traditional tools are running short, or you have to say you have to be a bit more creative in the tools that you need to use. And one of the tools which they haven't used yet, but is likely to come, at least if you look to the news for this week, there has been a lot of talk about we will see yield curve control from the Federal Reserve before New Year's. And what is yield curve control? I tried to ask a couple of my viewers and most of them were like, I have absolutely no idea. So I thought it would be a good idea to actually dive a bit more into the concept and try and explain it, so you hopefully will learn something new. So in order to understand what yield curve control is, first you need to understand the concept of a yield curve. Hence I have made this drawing of a yield curve. A yield curve is the relationship between time to maturity and yield. So for instance, 5 years to maturity, 3% yield, 30 years to maturity is 6% interest rate. Then you have all these different points, then you connect them, then you have a curve. That is a yield curve. This is known as an upward sloping yield curve, since if you were to draw a tangent anywhere on this line, it will have a positive slope. Effectively, that means that money today is more valuable to you than money tomorrow. What you are usually depicting in this yield curve is government bonds, since that is the closest thing we have to something being risk-free. So for instance, if you have a government bond with 5 years to maturity, then you will receive a 3% interest rate or 3% yield on an annual basis. If you have a government bond which expires in 30 years, then it will pay a 6% interest rate every single year. So effectively, you have mapped the risk-free rate, or the best proxy you have for a risk-free rate. So now you know what the yield curve is. Then we have to go and look into what the Federal Reserve is doing. Usually what you do when you go and stimulate the economy, then you do all these lowering of interest rates in the very, very short term. For instance, overnight interest rates. So when a bank deposits money to the central bank overnight, then it will receive the money the next day plus a little interest. And to do yield curve control, then you go to longer maturities and try to control the yield there. And when you look to this graph, then you start to understand the concept of why they have to go to longer maturities, since Jerome Powell is not interested in lowering the yield to less than 0%. So when you can't go any lower in the short term, then you have to move longer out of the curve and try to control what the yield should be there. Hence, when he has used the notion, we will do whatever it takes if it is not enough to buy bonds in the short maturity or with short maturity, then they will have to move longer out of the curve, since they are not willing to let the yield go below 0. Since a lot of my viewers do not know what yield curve control is, then I think it seems like a fair question to ask, have we ever seen this in the history before? And the matter of the fact is we have. If you go to Japan, they have used yield curve control since 2016. And in March this year, Australia imposed yield curve control. And if you go back to the Second World War, after the Second World War, that is the last time yield curve control has been used as an instrument by the Federal Reserve. So this is in no way a new invention. It is just not very often it is used, since it is usually enough to lower the very short interest rate to 0% or very close to that. It only in very rare occasions that you have to go to longer maturities when it's not enough to lower the short-term yield. And next question, which seems fair to ask at this point in time, is why don't we see yield curve control more often? Well, first of all, usually it is enough to lower the interest rate in the very short term, close to 0%, in order to boost the economy. The next thing is the central bank is really putting its reputation at risk when they move to yield curve control. Because one of the downsides to yield curve control is, if we for instance say they want to control the 5-year rate at 3%, well then for the next 5 years they have to buy all the bonds necessary in order to keep the yield at 3%. And to do that, they might risk abandoning their target of keeping the inflation rate at around 2%. So if they are not sticking to their plan regarding the yield curve, then the inflation might run completely wild. On the other hand, if they will keep their promise on the inflation rate, well, then they can't keep their promise of the yield curve rate. So that is why you usually do not see this. The first point is usually it's not necessary. The second point is they are really putting their reputation at risk. So it's highly likely when the Federal Reserve will move to yield curve control, if they move to yield curve control, that it will be in the short term. I don't think that they will go out longer than 5 years. But let's see, it will be very interesting to follow at this point in time. So what are the benefits of doing yield curve control? Well, in theory at least, it is the same as lowering the really short-term interest rates close to 0. So you would be able to get a mortgage loan with a low interest rate. It should feed through to car loans and corporate debt, and it would also lead to higher stock prices and a cheaper dollar. All is known as the same thing as lowering the short-term interest rate, so it's effectively just more of the same. The downside, or the thing that really is important here, is the market has to believe that the Fed will stick to the plan. And when you do yield curve control, you can't afford to have a limitation on how many government bonds you're willing to buy on the maturity that you have set out an interval for. Hence, it is really crucial that Jerome Powell used the notion, we will do whatever it takes, in order for the market to believe that they are actually willing to do that for the 2, 3 or 5 year bonds where they're going to apply this interval to, most likely. So that pretty much covered what yield curve control is. I will of course include a link in the description below to an article from Brookings, which in great detail explained what yield curve control is, some of the benefits, some of the downsides, and what it actually is. I will also include a link to Bank of Japan so you can see how they have imposed it over there, for those of you who are more interested. And as always, feel free to comment if there's something here which is not clear. I have tried to explain it as simply as I can, but maybe there's something which is still not clear, then feel free to send an email or leave a comment down below. So that covered the financial news for this week. I know it was only actually one news item, but I thought it was better to go a bit more into detail for that one and try and explain the concept than trying to cover much more and broader news. So without further ado, let's dive into my portfolio and see what has happened within the week. So as always, the first thing we notice is my portfolio is up in value, hence the green circle. The portfolio value is actually up $3,000 compared to last week. Of course, you can see that the cost base has also increased by $250, which means that my portfolio is actually only up by $2,750. And the obvious question is, what have I invested in? So that is actually quite easy for me to answer, since it's just more of the same. $250 went into LTC properties, the same as last week, since I still think that there is value in that company, and that's why I have invested there. So the $250 which I have invested is again a mixture of dividends and fresh capital. So since it's now the end of the month, let's go and take a look at the dividends tab. So as I mentioned last week, I hope that I would be able to breach the $200 mark yet again, and we can see that I have just done, since I received a little more than $2 from Starbucks. That meant that I this week have to come up with much more capital from my savings in order to keep up with the $250 every week. There's no particular reason for why it has to be $250 per week. For me, it's just a good and round number to be able to apply around $1,000 every single month. And this actually leads to a question which I have received from one of my viewers on what my plan is with the portfolio. How do I intend to invest in the current environment, and what are my thought process around it? So since I have not received any quarterly updates for any of the companies in the portfolio, then I think it makes sense to jump directly to questions from the audience. So the first question which I have received goes like this: how do you plan to invest in the current market? Can you give some scenarios, and why is there no bonds in your portfolio? So the question is really twofold. So if we start by looking at the different scenarios, I've tried to make 3 different scenarios where we go from the worst possible outcome, then to a sort of intermediate outcome, and then the third outcome, which would be really positive. So in my first scenario, there will be no recovery for the US economy within this decade, meaning for the next 10 years, we will not come back to the same levels which we were at before this crisis. So there will be perhaps low inflation or even deflation, as we have seen in Japan. Unemployment will keep increasing, and we won't see a vaccine until the end of the decade. So this is really a harsh outlook. If we then take scenario number 2, we will have a more slow recovery, perhaps similar to what we saw in 08 and 09, so it will take 5 years to get back to the same unemployment level, which will mean we will have a large amount of people defaulting on their loans. It will take longer than expected to having a vaccine which will be mass produced and spread across the entire world. If we then have scenario number 3, which is the most positive one, the US economy will recover quickly, people will quickly regain their jobs, and we will have a vaccine really fast within 2022. So to answer the question, what will you do in the different scenarios then? Well, in scenario number 1, you could argue that I should stop investing now if I expect that the market will drop heavily. Well, even if scenario 1 happens, how can I be certain that that is what I'm looking at? So if I keep dollar cost averaging in, then no matter if it is scenario 1, 2 or 3, then I will at least be better off than being completely out of the market. So with scenario number 1, I will keep dollar cost averaging, and if I see severe drops, then I will most likely invest more aggressively. If we then move to scenario number 2, well, if I look back to 08 and 09, well, then I should really start putting all my money into the market, because that was the best time to invest. And since I'm not sure that scenario number 2 will unfold, then I will apply the same logic and say I will dollar cost averaging in, because there will probably be some drops, and if the market increases, well, since I was not sure what was going to happen, I just followed my strategy. If we then go to scenario number 3, the really optimistic one, then instead of just dollar cost averaging, then you could argue that I should just invest all my money now. But again, since I'm not sure that we are in scenario number 3, I will dollar cost average, and then I will of course lose some potential gain. But losing some potential gain but being more secure is more important to me. Hence, that's why I'm sticking to my strategy, and depending on which scenario we're leaning to, then I perhaps will diverge from my strategy being more aggressive or less aggressive? A fair question to ask at this point is, well, haven't you behaved like it was scenario number 3 when you invested in January and February? And of course you can say that I did that, but that was before I was thinking about this pandemic. I was not looking to scenario 1, 2 or 3 here. I was simply building my portfolio for the long-term view. So now I'm sticking to my strategy, and I would expect it will take at least 2 or 3 years, or maybe even 5 years, before my portfolio will be in positive territory, since there is no bonds. So my portfolio is supposed to have more volatility than if there are bonds in it, which leads to the next question that the viewer asked. So to answer the second part of the question, why is there no bond in your portfolio? Well, first of all, I'm using Revolut, so I can only buy stocks. But besides that practical problem, if you haven't read The Intelligent Investor, I will of course highly encourage you to do so, but let me try and give you an answer which you can actually find in the book. So if you have read chapter 4, The Defensive Investor, and then if you go to the commentary section on page 105, there is actually a small minority of people for which it makes sense to have 100% of their investment in stocks. There are 6 questions you need to ask yourself, and you need to be able to say yes to all of them. So the first one, have set aside enough capital to support your family for at least 1 year. Will be investing steadily for at least 20 years to come. Number 3, survived the bear market that began in 2000. Number 4, did not sell stocks during the bear market that began in 2000. Number 5, bought more stocks during the bear market that began in 2000. And finally, number 6, have read chapter 8 in the book and implemented a formal plan to control your own investing behavior. So if you look to my answer for the 3 different scenarios which I just laid out, then I think I can actually say yes to all of them, since I have a plan for how I want to keep investing, and I survived the bear market. I intend to invest for at least 20 years. I have set aside enough money so I can support my family for at least 1 year. So that is why I don't have any bonds in this portfolio. I'm not suggesting that you should do the same. You should follow an investment strategy that makes you sleep well at night. So for instance, if we go back to 2000, if you there have had a portfolio with 25% bonds and 75% stocks, then you would have been in negative territory for 3 years, compared to a portfolio which would have had 100% in stocks. Then it would have taken you 5 years to be in positive territory. And 5 years is really a long time. Look at this channel. I mean, I have been doing this for 4 months now, and I have been down most of them, almost since I started. And that is just 4 months. Keep looking into this for the next 5 years and expect to be in negative territory. Unless you are okay with that, then you should probably buy some bonds. The reason for me not buying bonds is it's not appealing to me to buy bonds where the interest rate is so low that I actually know that I will lose money due to the inflation. Then I will rather stick to a bigger cash cushion, meaning that I'm capable of supporting my family for at least 1 year, and then invest the rest of my money, since I know that I will be investing for at least 20 years. That strategy is simply more appealing to me, and especially when it is dividend growth investing that I'm doing, since I will receive some cash flows from the companies which I am investing in. And on top of that, the companies which I'm currently looking at or trying to continue to add to my portfolio is those who are still paying out the dividends, even under the circumstances that we are seeing now. But that's not to say that you should do the same. This is just to try and answer why there's no bonds in my portfolio. You can of course argue that you should have bonds in your portfolio, and if you have a different appetite to risk, by all means, that could very well be the best strategy for you to follow. The next question I have received goes like this. Why do you always look at Germany when you're talking about the European economy, even though that you are from Denmark? So the reason why I always talk about Germany when I talk about the European economy is very clearly depicted in this map by a user on Reddit, Nerded Maps. Shout out to that guy for letting me using his map in my episode, because here you can clearly see that Germany is the biggest economy inside the European economy. And I mean, Denmark is not even in top 10. You have Sweden on 10th place, and they are a much bigger country than Denmark. And you also have to note here that Turkey is not included, but if they were, they would be in place number 8. So this is why I always focus a lot of my attention to Germany whenever I am talking about the European economy. And since there is a lot of international viewers on this channel, I think it makes more sense to focus on the bigger economy instead of just focusing on Denmark, since we are a tiny minority compared to the rest of the world. So that covered yet another exciting week on the stock market. So now you know what yield curve control is. You also know why there is no bonds in my portfolio, and why or why not it may be beneficial for you to do the same. And as always, remember to comment, like and subscribe. And until I see you next Sunday, bye!